These are the retirement withdrawal strategies that could make or break your financial future. And one simple rule has dominated retirement planning for over 3 decades. This is the story of the 4% rule, why it might be outdated, and how new research suggests you could be leaving tens of thousands of dollars on the table. Picture this. You've spent your entire career building a retirement nest egg of $1 million in your 401k or IRA. Under the traditional 4% rule, you'd withdraw $40,000 in your first year of retirement, then adjust that amount for inflation each subsequent year. The promise? Your money will last 30 years with a 96% success rate. But here's what most people don't know. The man who created this rule now says you can safely withdraw significantly more. The 4% rule emerged from the mind of William Bengen, an unlikely retirement guru. Born in Brooklyn in 1947, Bengen wasn't a lifelong financial planner. He started his career as an aerospace engineer with a degree from MIT in aeronautics and astronautics. But when he couldn't find a satisfying answer to the fundamental question of how much retirees could safely withdraw from their savings, he decided to crunch the numbers himself. In October 1994, Bengen published his groundbreaking findings in the Journal of Financial Planning. His research analyzed hundreds of historical retirement scenarios, examining what would have happened if someone retired at various points throughout the 20th century. He discovered that even in the worst-case scenarios, like retiring at a market peak in 1968 before a protracted recession and the high inflation of the 1970s, a 4% withdrawal rate allowed retirement funds to last 30 years. The original math actually came out to 4.15%, but it was rounded down in publication, and the round number stuck. Bengen's research assumed money held in tax-advantaged accounts, a 30-year retirement horizon ending with a zero balance, a fixed allocation of 60% stocks and 40% bonds, and annual rebalancing to maintain target weightings. The rule gained additional credibility in 1998 when 3 finance professors at Trinity University published what became known as the Trinity Study. Their research, analyzing data through 1995, largely confirmed Bengen's findings and helped cement the 4% rule as conventional retirement wisdom. But here's where the story gets interesting. Despite creating the rule that bears his name, Bengen himself has been quietly updating his research for decades. In 2006, he revised his recommendation to 4.5%. Then, in August 2025, at age 78 and navigating his own retirement, Bengen published A Richer Retirement, revealing his latest findings that challenge everything we thought we knew about safe withdrawal rates. According to Bengen's most recent analysis, the safe withdrawal rate isn't 4%, it's 4.7%. He calls this the universal safe max, representing the historical maximum safe withdrawal rate for all retirees. But that's just the worst-case scenario. For today's retirees, Bengen suggests something around 5.25% to 5.5% would be appropriate. The difference is staggering. On a $1 million portfolio, the gap between 4% and 4.7% means an extra $7,000 per year. But if Bengen's current recommendations of 5.25% to 5.5% are accurate, we're talking about an additional $12,000 to $15,000 annually. Over a 30-year retirement, that could mean hundreds of thousands of dollars in additional spending power. So what changed? Bengen's latest research incorporates a more sophisticated analysis using a broader range of assets. His original work only examined portfolios containing U.S. bonds and large U.S. stocks. The updated model includes international stocks and small to mid-cap companies, creating greater diversification. As Bengen explains, each one of them has its own cycle of investing, and each contributes to the diversification of the portfolio and increases the withdrawal rate. But Bengen isn't the only researcher updating withdrawal rate recommendations. Morningstar, the investment research firm, has been conducting annual Monte Carlo simulations on safe withdrawal rates since 2021. Their findings have fluctuated significantly: 3.3% in 2021, 3.8% in 2022, 4% in 2023, 3.7% in 2024, and 3.9% in 2025. These variations reflect changing market conditions, particularly interest rates and inflation expectations. The conservative approach from Morningstar highlights a key tension in retirement planning. While Bengen suggests retirees can safely withdraw more, other experts urge caution. Amy Arnott, a portfolio strategist at Morningstar, acknowledges that the 4% rule is a reasonable starting point, but their research consistently suggests lower withdrawal rates for those seeking steady, inflation-adjusted spending. One major factor driving these different recommendations is the interest rate environment. The original 4% rule research assumed bond yields of 6 to 7%, typical in the 1990s. Today's bond yields of 3 to 5% create a fundamentally different landscape. Lower yields mean portfolios may struggle to sustain the same withdrawal levels, especially during market downturns. This brings us to one of the most critical concepts in retirement planning: sequence of returns risk. It's not just about average returns over 30 years, it's about when those returns occur. Losses in the early years of retirement are particularly devastating because withdrawals during market downturns lock in those losses, leaving less capital to recover when markets rebound. Researcher Wade Pfau estimates that 77% of final retirement outcomes can be explained by average returns in just the first 10 years of retirement. The timing problem is so significant that financial planners have identified the fragile decade, the 5 years before and 5 years after retirement begins. During this window, when portfolios are typically at their peak size, severe market downturns can wipe out years of accumulated gains. Despite these risks, there's mounting evidence that the traditional 4% rule might be overly conservative. Bengen himself notes that most of the time you will die with many multiples of what you started with. His research spanning the last 100 years shows an average safe withdrawal rate of 7%, dramatically higher than the conservative 4% figure most people follow. The financial independence, retire early movement has embraced the 4% rule as gospel, with participants saving 50 to 75% of their income to accumulate 25 times their annual expenses. But for FIRE adherents planning 50-year retirements instead of traditional 30-year horizons, the 4% rule becomes problematic. Extended retirement periods require more conservative withdrawal rates or more sophisticated strategies. Modern retirement planning increasingly favors dynamic approaches over rigid rules. Morningstar's research shows that flexible strategies, including delayed Social Security claims, guardrails approaches that adjust spending based on market performance, and Treasury inflation-protected securities, could support withdrawal rates as high as 5.7%. The guardrails approach represents a particularly promising evolution. Originally developed by financial planner Jonathan Guyton and computer scientist William Klinger, this strategy involves adjusting spending instead of fixing withdrawal rates. Retirees adjust their spending based on portfolio performance. Morningstar's specific guardrails strategy suggests a starting withdrawal rate of 5.2% for balanced portfolios, with built-in mechanisms to reduce spending during market downturns and increase it during good times. Even more intriguing is the TIPS ladder strategy. As of September 2024, building a 30-year ladder of Treasury inflation-protected securities would support a 4.4% withdrawal rate with 100% certainty of lasting 30 years, though this approach depletes the portfolio entirely by year 30. The criticism of rigid withdrawal rules isn't new. Economist Lawrence Kotlikoff dismisses the 4% rule entirely, arguing it has no connection to economics and represents an irrational and economically inefficient withdrawal strategy. He advocates for spending strategies that adjust based on actual portfolio holdings and market conditions. The most important insight from decades of withdrawal rate research is that retirement planning isn't one size fits all. Today's retirees face unique challenges: longer lifespans, varying market conditions, different spending patterns, and diverse asset allocations. A 65-year-old couple now has a 50% chance that one spouse will live into their 90s, potentially requiring retirement funds to last 40 years or more. Additionally, retirees over 73 must navigate required minimum distributions, which can conflict with optimal withdrawal strategies. William Bengen, now experiencing retirement firsthand, seems to have evolved toward a more flexible philosophy. His latest work suggests that while 4.7% represents the worst-case withdrawal rate, most retirees could safely withdraw 5.25% to 5.5%. His advice carries particular weight. After all, he's the man who's been studying this longer and more rigorously than anyone else. As Bengen puts it, if you take less, the odds are very high that you're going to end up with a big pile of money when you retire, and a lot of regrets for not having spent more during retirement. The real tragedy isn't running out of money. It's living too conservatively and missing out on experiences because you followed an outdated rule. The 4% rule served as crucial foundation for retirement planning, providing a simple framework when none existed. But 3 decades later, with more sophisticated research, better data, and deeper understanding of market dynamics, it's time to evolve. Whether you follow Bengen's updated 4.7% rule, embrace dynamic withdrawal strategies, or chart your own course, the key is understanding that retirement planning has moved far beyond simple rules of thumb. The question isn't whether the 4% rule is dead, it's whether you're brave enough to live a richer retirement.